What's going on? I am the covered call guy, and yes, this is the end of the month portfolio. 6 holdings, year to date chart has been up and down. It's been a wild ride. And for those who are not new, and you're wondering where is MAGY and BTCI, I've exited the position. It's gone. It's out. I'm out. I'm done. And as you can see, I've started to build IWMI, SPYI, and QQQI. I'll be getting into that a little bit later, but for this video, I'm going to be talking about why I exited my positions in MAGY, and yeah, and what my focus will be for the rest of 2026. So the 6 positions right now is what I'm going to be focusing on for 2026. My year to date, I'm pretty much just making this nice W shape. Yeah, I'm gonna be sharing my thoughts on why I exited MAGY. As much as I loved it, but it was time for me to let it go. So today's video is gonna be on my $55,000 lesson learned. This is gonna be my brutally honest state of my weekly ETF portfolio. I'm giving myself a reality check here, so it is a little bit depressing because I did love MAGY, but I'm not married to any stock, and you should never be married to any stock or ETF. But I'm gonna be talking about my $55,000 loss today. Well, not loss, but lesson learned. All right, so my $55,000 weekly ETF lesson. Essentially, I had about $55,000 into a single weekly paying ETF because I wanted that cash flow, right? But taking a look back, I had to take a step back and ask myself, as much as I love MAGY, I don't think MAGY was an issue. I asked myself, is Roundhill evolving intelligently or diluting itself, chasing attention, right? This ended up being my weekly payer lesson because of Roundhill. Not because of MAGY itself, but because I think Roundhill is heading into a direction that I'm not comfortable with and that I don't like. I mean, I just don't think they're heading in a direction that I feel comfortable. Where are they trending in a yield max scenario, or are they actually being a competitor in this ETF space? So this Roundhill was the reason why I sold MAGY, not because of MAGY itself. I do believe MAGY could have rebound, but overall MAGY does fall under the umbrella of Roundhill, and so Roundhill started to frighten me with how they're just pumping out ETFs after ETFs instead of focusing on what they already have. All right, so why did I choose Roundhill, right? I want to talk about the good of Roundhill and why I chose in the beginning, right? Because of the track record, right? Of course, why would I just throw $55,000 blindly, right? That's just not how I do things. Roundhill actually hit the scene in 2018 to disrupt legacy management, right? They were the innovators. That's why I like them, the innovation to break the mold, break the old ways, right? The old guard, right? But by November 2025, right, they have passed 10 billion in assets under management with 5.5 billion in inflows. That's the reason why you follow the money. People wanted it, right? This is the original appeal of it. I thought I was buying into a calculated strategic evolution, right? A firm that understood structural demand for income and volatility monetization. And to me, they looked like the undisputed future of ETFs at the time, right? That was my buy-in, right? And I asked myself, right, are the original betters, right? Should they have stayed with their old philosophy, which was original, the thematics, right? I love the early stuff, right? Funds like Nerd, Bets, and MetsV were grounded in real multi-year growth themes, right? And I genuinely asked, are their older thematic funds just better than these new yield traps? They had concentrated beta, right? They pivoted hard to extreme concentration in 2023 with mags and chat. Of course, it worked, but it started a dangerous trend of hyper specified city that led us to where we're at today. And that is where lifecycle compression, and this is what terrifies me, right? They aggressively market new tickers, gathered early assets, and then ignore them. I mean, it feels like they're not paying attention to what they already have, right? To the consumer base that they already have grew and grown, which I was part of, right? And I became deeply worried that they were just abandoning the refinement of legacy funds that are good, that works, right? And with the new releases, and it's just I think they're just chasing the names, the trends, the memes, and that was probably the sole reason why I kind of cut my losses with MAGY. I just felt like, as much as I wanted a weekly, I could do without a weekly and just purely stick with monthly. And yeah, I mean, Roundhill, I was gonna try to hold it a little bit longer and give it some time, but I think Roundhill really showed me that it can't hold up. It's heading in a path that they could end up like YieldMax and just keep pumping out ETFs after ETFs after ETFs and just not really care about what they already have. Right? This is the spaghetti strategy, right? So if you look at the product pipeline over the last 6 months, from August 2025 to about February 2026, it has shifted almost entirely towards high frequency income gimmicks and headline chasing themes. Go look at it. Go look what they pumped out, right? They're essentially pumping out hyper specific single stock income funds designed to mimic competitors and capture fleeting market narratives, okay? It's the literal definition of throwing spaghetti at the wall to see what gathers retail assets, right? It's the frenzy, and they're just trying to collect. And at the end of the day, I think they're just trying to collect the expense fees, right? And that is something where I start to lose confidence and I start to lose trust. And if I start to see that they don't care about what they already have and what they can build and focus on, I'm out. And so I cut my losses with Roundhill. This is one of the reasons why. All right. 6 months of mayhem, right? September 2025 with WPAY launched the weekly pay universe ETF. It is a funds of funds heavily criticized as a direct unoriginal clone of UMax, YMax, and YMAG, right? By November 2025, they have TSYW, Treasury Bond Weekly Pay. They attempted to apply synthetic weekly options to government debt, right? To me, that made no sense. December 2025, right? United Health Weekly, right? Continued the single stock clone wars by targeting United Health Group with synthetic cover calls. Why? January 2026 with cabs, right? Robotaxi and auto tech ETF launched at the absolute peak of speculative frenzy of Tesla's robotaxi network. Pure retail hype. Of course, it could have worked out and it still can work out, but why are they doing this? I mean, focus on quality, right? Not quantity. And then I made a video about this. February 2026, they released T-Pay, right? Targeted 10 managed distribution ETF engineered to distribute a fixed 10% annualized return of capital, which is very specific and niche and narrow in a way that it targets very specific group of people that should be using it, right? But of course, people don't know about it. So they see 10%, they don't really know about it, and they just buy it. Their target, and it just felt very schemy, kind of like a loan shark type of, very predator. And I don't like that. It's just they're not. I don't feel like they're being at least honest, and I for that, it just had a gut feeling. All right, so courting animal spirits, what is it? Just chasing hype, right? I talked about previous slide, launching cabs exactly when Twitter or X now and Reddit were foaming at the mouth over robotaxis, right? Every single pumping out robotaxis, right? And reviving the meme, right? The ticker symbol meme, right? They essentially liquidated their meme ETF in 2023. Now that retail money is back, they are shamelessly revived it to track social volatility, right? This is pure gimmick. This is what I mean. I don't like this. I don't want this. I don't want my money in this. Right? And this is also exactly what worries me, right? This whole gambling thing, it's frustrating, right? So on February 13th, 2026, Roundhill filed for 6 2028 election ETFs, okay? They invest in binary event contracts. If the event happens to pay $1, if the event happens, it pays $1. If it doesn't, it pays 0, right? Their own SEC filing warned investors of a catastrophic loss in value, right? So if your political party doesn't win, this is the exact casino style gimmickry that makes me terrified to trust them with my $55,000, right? They are turning my asset manager into a sports playbook. To me, this is a huge red flag. Huge. They're essentially gambling with your money. I don't want that. And you know, I really wish they weren't chasing these thematic type of trends, but it's part of me, I guess I'm happy that they did, because now I know what type of issuer they are, company they are, fund manager, the whole their philosophy, their team. And now because of this, I feel like I'll just put my money else, split it else somewhere else. I'll put it into the 3 Neos stock that you've seen in my portfolio. So for 2026, I pretty much put the 55, split it across into SPYI, QQQI, and IWMI, and I'll be growing these 3 as of now for the rest of 2026. Right? So how did Roundhill become YieldMax, or are they starting to become YieldMax? All right, this is my biggest fear, right? The convergence isn't just thematics, it is deeply structural. I think this is their shift. They're really becoming a YieldMax 2.0. Right, so the YieldMax, the yield trap explained. Obviously, if you're new, right, if you're looking at Roundhill, because it is quite popular, right? Looking at the YieldMax model here, with the yield traps, YieldMax pioneered massive cash yield, right? They're the first one that came out with these 50 to 100 plus yield percentages, right? Using synthetic cover calls on hyper volatility stocks, but it has a fatal flaw, and that is asymmetric risk, right? NAV erosion equals when the upside is capped plus 100% downside risk. So essentially, you're selling calls, you cap your gains, but you remain fully exposed when the stock drops, right? So over time, this is mathematical asymmetry result in persistent, severe NAV death, right? Net asset value, NAV, and reverse splits. You've seen it. Of course, if you're new, then you haven't, but essentially that's what it is, right? So this is math. It's basic. You can't argue this. This is mathematical. The depth of your NAV. It's just the way it is. You can't get out of it. What is wrong? What's up? It's a little too big. It's cut off. Give me 1 second here. All right, I'll just talk it out. The title of this slide is the Clone Wars, right? I've talked about it previously. If you just look at it here, essentially, Roundhill launched their weekly pay suite specifically to mimic YieldMax, right? They claimed a 1.2x swap leverage. It makes them better. It just amplifies the volatility, right? Look at it. In the income of YieldMax versus Roundhill, identical core mechanism here. Right, both rely on headline shock value, both return your principal, and both are destructive assets. At least in my opinion, this is the way. This is why, I got out. I'm seeing they're really just becoming a slightly, quotes here, air quotes, slightly better YieldMax. Right, a YieldMax 2.0. If anything, a 2.1, whatever. Not ideal, not what I want. All right, so I'm all about the long-term hold, and I just feel like Roundhill, you're more short-term, so I'm out. All right, so this is of course, my personal nightmare of my $55,000 case study. Of course, I was the guinea pig here, right? So, of course, please, I need your thoughts and prayers. Leave it down in the comment section below. Just comment, thoughts and prayers. That's what I need right now. I mean, I'm in a tough situation. I'm a little bit sad, but it is what it is, right? So let's look at my massive position in MAGY, right? Right? Let's talk about the good of why I did buy it and why I did keep the faith for a while. One, MAGY, it is structurally sound. No matter how you want to play it out, it is structurally sound, right? So unlike YieldMax, MAGY is physically backed, right? It does hold about 99.85% direct allocation in actual MAGS ETF. No overnight synthetic blowups. It's good. That's a point. 2, it has absolute positive return, right? It is not destroying total wealth. So since April 2025, it has generated an 18.72% positive total return. Of course, if reinvested, a little bit less if not. Consistent weekly cash, right? It mechanically delivers on its promise, right? Paying a massive about 30% annualized yield into my account every week. That's the good, you know. The brutal, honest, bad news about it, well, of course, it is 100% return of capital, right? So it does give off the illusion of yield, right? This is the most damning fact, in my opinion, right? So, of course, I'm going based off according to their 1981 notice, an estimated 100% of my distribution is ROC. Roundhill is largely not distributing generated options income. Do I love ROC? Yes. Do I want 100%? Yes. Do I want it all the time? No. There's reasons for it. My reasons is I want to see you generate organic distribution and you know, option profits, right? So going back here, they are systematically liquidating chunks of my own $55,000 principal and handing back to me every week to create the illusion of about 30% yield while charging me a 0.99% expense ratio to do it. And that's another point. I don't think Roundhill will be good enough for them to be charging me 0.99% expense ratio with the way they're handling their business right now. I don't like it. Focus on what you have. I doubt they're going to be watching this video, but if they end up in this video, focus on what you have and stop pushing out these goddamn slop ETFs. Stop it. We don't want that. None of us do. None of us on this channel want short-term holds. We are for the long-term hold. We want sustainability, reliability, consistently, and actual backing. Not just constantly every month you're pumping out a new ETF. It's just it gives me a headache. But I'm out. You know what? This is my video on my perspective and my. It's about, this one is about me, so I'm just gonna vent, and again in the comment section below, thoughts and prayers, because I'm gonna need that one for a while. All right, look. All right, let's look at the sickening opportunity cost. Right, just holding tech of the MAG's growth ETF already shown a 42% total return. The YieldMax clone of YMAG 32% total return. My fund MAGY 18, right, and my fund MAGY price of negative 8.8 NAV erosion. All right, so of course, by capping my upside, I surrendered more than half of my potential gains compared to just holding MAGs. At that point, I could have just held MAGs, right? Worse, the actual share price plummeted 8.8% in just 6 weeks, and I'm losing to YieldMax. God, that is such a hit, right? That's such a stab right in, not even in the back, right in the front. Losing to YieldMax, oh my God. Thoughts and prayers, thoughts and prayers. All right. Losing faith in the issuer. I mentioned it. I'm just taking a quote from the institutional watchdogs here. Right. So in January 2026, Morningstar formally downgraded Roundhill to low parent pillar rating, citing an atrocious risk-adjusted performance with an average rating of just 1.0 stars. Okay. So it is logical to trust MAGY's weekly payout mechanism while losing all faith in Roundhill. They just tried to launch a recklessly leveraged 4x SPYI ETF, right? That SEC flat out rejected. They are acting like an offshore casino, right? The issuer has a goddamn problem. I don't know what's wrong with them. I don't know. At this point, I think they're just trying to buy a new yacht. I don't know. I'm a little. If you can tell, I'm a little pissed off. But deep breaths, thoughts and prayers, thoughts and prayers. All right. The graveyard in illusion, all right? So when the 100% 14 illusion, I'm talking about MSTW touted an astonishing 114% yield, but Morningstar basically said it is crap. It is crap. It literally charging whoever bought this, you're getting charged a 0.99% just to give your own money back plus possible taxes. The crypto illusion, similar to the Bitcoin fund of YBTC, right, relies heavily on ROC. Tax notices 100% specific payouts are just return on capital, not generated options income. So, I'm starting to see a pattern, and hopefully I'm putting you guys to start to see a pattern too for any Roundhill ETFs. I'm just not liking them. And then the graveyard, right? They relentlessly liquidate failed gimmicks. The big bank IO digital infra dividend monarchs. It's a massive launch to liquidation ratio that proves a churn and burn model. Right? This is showing me great neglect from them. So As of this video, of course, you already see my portfolio. I am out, so as much as I'm kind of like just venting out my anger, at the end of the day, I'm no longer holding any Roundhill products. So if you're watching this and you just bought Roundhill, I don't know, maybe it opened up your vision. Maybe you can counter my video with facts of your own. Again, this is just my opinion piece. What is my endgame strategy, right? So after looking at all this data, I have completely sold out of my entire $55,000 position in MAGY. I'm officially stopped the NAV bleeding and executing a highly prudent reallocation of my capital. What am I doing? I'll be focusing on building a portfolio around monthly cover calls and structured spread ETFs, pretty much using short-term call writing to generate consistent income. I'm using a more systematic option spread to define and manage risk, hence the 3 NEOS cover call ETFs I mentioned, SPYI, QQQI, and IWMI. I want a more index-based option overlay combined with a selective upside participation, NEOS, and disciplined strike management to balance income generation with potential NAV growth, NEOS. Right, so that's my action plan right now. I'll be making another video, a deep dive thoughts on what I'm really planning out for my 2026 game plan. It has completely kind of shifted. I don't think I will ever buy a weekly ETF again. I'm just going to be sticking with monthlies. So, yep. I don't know if you guys agree, disagree. Thoughts and prayers in the comments. Just type that out. That's all I need. That's all I want to read for this video. So, thoughts and prayers for me. All right. Like I said, the NEOS escape route, right? The NEOS, why NEOS? Why, of course, if you're new, why NEOS, right? So instead of standard cover call that caps all my upside, NEOS actually uses a call spread that allows for NAV growth, right? So it captures upward market momentum, preventing the relentless NAV erosion that happens when you pay out weekly options while the underlying gets beaten down and your recovery is capped, right? And it has great, massive tax efficiency. That's my reallocation game plan for 2026. All right. I am thinking about DIVO. Not really, but I am. That's on the side. If DIVO does take a deep hit on the price, I will get into NEOS. So I think NEOS is really going to be the ultimate portfolio stability. It is going to be on my kind of like my back pocket, right? I'm keeping an eye on it. I have a lot of price triggers for it. So every time it goes down, I just take a look at it and say, okay, all right, it's not down enough, but it is going down. What's going on with the market? I do love NEOS. NEOS will be in my portfolio without a doubt. Wait, DIVO will without doubt be in my portfolio. I think DIVO is going to end up being my main core, overtaking GPIX and GPIQ. DIVO is just a great foundation. And it's Amplify, right? Amplify has been doing good. Amplify so far, I'm pretty happy with them. No gimmicks, no trendy, no thematics, no just meme writing, right? So doing pretty well. All right, you be the judge. Leave your thoughts and prayers in the comment section below. So if you found this video funny, creative, laughing at my pain, give me a subscribe, like, comment. If you're on the same journey as me, of course, come on, follow the channel. If you're new, stick around. Make me a better investor. Maybe I'll make you a better investor. So hopefully you guys like what you see in this video. Informational, my pain, my suffering. I'm a little sad, but I'll get some laughs in the comment section. Thanks for watching, guys. See you in the next. Catch you guys. Stay tuned.